Hello and welcome to TradeFlow Television,
bringing you valuable analysis and actionable intelligence
for the global commodity markets.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Oil prices were mixed on Friday but posted a fourth straight week of gains ahead of an OPEC Plus meeting early next week. Brent crude January futures rose 38 cents to settle at $48.18 a barrel, while the more active February contract gained 46 cents to $48.25. U.S. West Texas Intermediate (WTI) crude futures fell 18 cents to settle at $45.53 a barrel. Brent rose 7.2% over the week, while WTI gained 8% for the week. Encouraging news on potential COVID-19 vaccines from AstraZeneca and others have lifted the markets. However, questions have been raised over AstraZeneca's vaccine for the world, with several scientists sounding caution over the trial results.
Asian spot prices for liquefied natural gas rose this week, driven by a surge in oil prices and a potentially colder start to winter and higher heating demand. The average LNG price for January delivery into Northeast Asia LNGers was estimated at around $7.40 per million British thermal units, up $1 from the previous week, industry sources said. Brent oil futures, which the majority of Asian LNG contracts are priced against, rose 6% this week to the highest since March as traders were optimistic about oil demand recovering due to developments with various coronavirus vaccines.
Moving on to the top news in the energy sector.
Japan, South Korea and a fleet of international shipping groups have warned the European Union against its plan to add greenhouse gas emissions from the maritime sector to Europe's carbon market. As the 27-country EU seeks to steer its economy towards net zero emissions by 2050, the Executive European Commission wants to expand its carbon market to shipping. Currently, the policy requires power plants, factories and airlines running European flights to buy pollution permits to cover their emissions. The proposal, formally due by next summer, has already run into opposition.
Malaysian state-owned energy giant Petronas swung to a third-quarter loss on Friday and warned the remainder of the year would remain tough due to prolonged low oil prices and demand hampered by coronavirus restrictions. The world's fourth-biggest LNG exporter reported a loss of 3.4 billion ringgit ($836 million) for the July to September period, against a profit of 7.4 billion ringgit in the same quarter last year. Amid the fluid operating environment brought about by the pandemic as well as prolonged volatility of oil prices, Petronas is adopting a cautious outlook and anticipates that the remainder of 2020 will be challenging, Tengku Muhammad Taufik, President and Group Chief Executive Officer said in a statement.
Moving on to metal price moves.
Customers of Tianqi Lithium Corp insist they have other suppliers to turn to if the heavily indebted Chinese firm, which is facing an imminent loan repayment deadline, fails to secure the refinancing needed to stave off a default. Tianqi, one of the world's top makers of lithium chemicals used in electric vehicle batteries, on Tuesday repeated its warning that production could be severely impacted if it fails by the end of this month to make a $1.9 billion repayment on a loan used to buy a stake in Chile's SQM in 2018. The firm currently has a 12.9% share of the global lithium chemical market, says benchmark mineral intelligence analyst George Miller.
Gold slumped 2%, breaking below the key $1,800 support level to a near 5-month trough on Friday, as growing optimism about a quick vaccine-fueled economic recovery and a smooth White House transition powered U.S. equities to records. Spot gold slid 1.3% to $1,787.46 per ounce by 1:15 p.m., earlier falling to its lowest since July 6 at $1,773.10 an ounce. The metal has shed about 4.5% so far this week, the most since the week of September 25. U.S. gold futures settled down 1.3% at $1,781.90 per ounce.
We will now look at the top news in the agricultural sector.
India's imports of palm oil are set to rise by as much as 100,000 tons a month from December after the government slashed import tax on the tropical oil, making it cheaper than rival edible oils, industry officials said on Friday. Higher imports by India, the world's biggest buyer of palm oil, will support benchmark Malaysian palm oil prices that hit their highest level in 8 years this month, but could weigh on U.S. soy oil futures. India on Thursday slashed import tax on crude palm oil to 27.5% from 37.5% as it tries to curb rising food prices. That is all for today's news on the commodity market. Stay tuned to TradeFlow TV as we continue to provide you with more updates. You can also follow us on Twitter at TradeFlow TV1, which allows you to watch our program on your mobile device or desktop.